Welcome, BAccSc CTA SAICA candidates, to this special Inclusions Masterclass. Today, we are systematically mapping out the categorical framework of special inclusions in gross income. Now, if you're gearing up for your exams, you already know that the general gross income definition, well, it can really only take us so far. It's got loopholes, people find ways around it. So today, we're zeroing in on the specific legislated inclusions that drag these tricky receipts right back into the tax net. We're going to look closely at paragraphs G through I of the gross income definition, breaking down the exact requirements and the tax consequences you need to know.
Okay, here is our roadmap. We'll be covering paragraph G for lease premiums, paragraph GA on know-how payments, paragraph H for leasehold improvements, and finally paragraph I, fringe benefits.
Let's kick things off with paragraph G, lease premiums.
Paragraph G brings amounts received for the use of land, buildings, and even things like motion picture films or patents directly into gross income. It's a classic inclusion designed specifically to stop landlords from disguising a massive upfront rental payment as capital in nature. But here's the catch, and examiners absolutely love to test this. The Income Tax Act doesn't actually define a lease premium. That's where the landmark case of CIR versus Butcher Bros comes in. To get caught in this net, your scenario has to hit three specific prongs from that case. The amount must be paid by the lessee to the lessor. It can be paid in cash or otherwise, and it has to be specifically for the use or the right of use of those designated assets.
Now, pay close attention to the strict legal distinction here. We're talking about actual physical use versus paying merely for the right to sign the lease. Use refers to an upfront payment for the actual practical utilization of the assets. You're paying to walk into the building and operate. Right of use, on the other hand, is an upfront payment just for the right to enter into the lease agreement in the first place. Paragraph G is drafted broadly enough to capture both. So whether your client is paying to physically use the building or paying just to hold the pen to sign the lease, the ultimate tax treatment for the recipient remains exactly the same. It's fully taxable.
Moving right along to paragraph GGA, know-how payments.
Let's see how this framework builds as we transition from physical, brick-and-mortar assets to specialized intellectual property. We aren't talking about buildings anymore. We're talking about the specialized knowledge required to run a complex process or utilize a patent. A massive common trap for students here is thinking that just handing over a USB drive with data on it counts. It absolutely doesn't. As we see here, imparting implies an active transfer. It brilliantly illustrates the active nature of sharing scientific, technical, industrial, or commercial information, what we call STIC information. It's actively rendering a service. If a taxpayer receives a payment for actively imparting this STIC information, teaching, or transferring that specialized capability, it falls squarely into gross income under paragraph GA.
Next up, paragraph H, leasehold improvements.
We are pivoting back to physical property agreements now, specifically looking at what happens when a tenant upgrades the owner's property. Paragraph H is a massive exam favorite because it involves two distinct taxpayers, the lessor and the lessee. And you guessed it, you have to calculate the tax implications for both. But to actually trigger paragraph H, there must be a concrete contractual obligation binding the lessee to make these improvements. It cannot just be a voluntary renovation. This is exactly where so many candidates trip up. If a tenant simply decides to paint the walls and install fancy new carpets out of the goodness of their heart, it doesn't automatically trigger this inclusion for the landlord. The lessor must have a legally enforceable right to have those improvements effected. That agreement obliging the lessee absolutely must exist.
In an exam setting, you have to track the mirrored consequences for both parties. For the lessor, the value of those improvements gets slapped straight into gross income under paragraph H, though keep in mind, they might get some relief under section 11H later on. But the lessee, the one actually spending the hard cash, they get to claim a section 11G allowance. They must deduct the cost over the term of the lease, starting from the completion of the improvements, and this is strictly capped at a maximum of 25 years. Let's anchor this with a practical scenario. Take John, he's our lessor. His lease agreement clearly stipulates that improvements to the value of R40,000 must be made by the tenant. Because of that specific clause, John is taxed on exactly $40,000 in the 2025 year of assessment, regardless of what the lessee actually ends up spending out of pocket. This is a vital principle to grasp. Even if the lessee manages to call in a favor and gets the work done for cheaper, or ends up wildly overspending, the lessor's tax burden is tied purely to that legally stipulated contract value.
Now, in comprehensive SAICA-style questions, examiners are rarely going to test these paragraphs in isolation. They love to mix them up. If a lessor receives a lease premium upfront and also mandates leasehold improvements in the contract, both of those amounts stack up rapidly.
This could potentially push a simple tax calculation to well over 100,000 Rand in gross income inclusions alone, and they stack right on top of regular rental income. It requires a really meticulous, step-by-step approach on your end to ensure nothing slips through the cracks.
Let's shift gears entirely now to paragraph I, fringe benefits. We are leaving asset and property agreements behind and focusing strictly on the distinct rules governing the employer and employee relationship. Paragraph I shifts our attention to how we value and tax the perks of employment. Under this paragraph, the emphasis is entirely on the non-cash perks that flow to an employee, cleanly separating them from standard cash remuneration. We're talking about company cars, free accommodation, low-interest loans, basically all the things that make a job attractive beyond just the monthly paycheck. Because these aren't cash, the general gross income definition really struggles to capture them effectively. So paragraph I specifically sweeps these non-cash benefits right into the tax net. It ensures that an employee who is compensated in cars and houses is taxed fairly alongside an employee who is compensated entirely in cash.
So as you hit the books and prepare for your exams, think about how these special inclusions systematically close the gaps on value transfer. They leave almost nowhere for untaxed wealth to hide. Whether it's a landlord forcing a property extension, a company actively imparting commercial know-how, or an employer handing out company cars like candy, the Act has a specific paragraph waiting to catch it. Master these rules, and you're going to navigate your exams with absolute confidence. But it does leave you with a provocative thought. When you finally step into practice, just how tightly drafted will your client's contracts be to actually survive this level of scrutiny?